Let's start out with another prediction. There will be, sometime in the future, another bear market.
Yeah, I don't believe that.
Not that kind of bear. I'm talking about the stock market. So for those that aren't aware, a bear market is loosely defined as a decline in a major index of 20% or more in a period of at least a couple of months. The last major bear market was, of course, during the Great Recession. The stock market was cut in half and then some. So in my previous video about economic cycles, I proposed that we would be unlikely to get through the next presidential term without a recession occurring, based largely on the fact that no economic cycle in US history has gone on that long. Now, when it comes to the stock market, the average bull market in the post-war period is just over 4.5 years, with an average increase of about 136%. The current bull market is now 7.5 years old and has risen 224%. The 1990s bull market is the longest on record, lasting just shy of 9.5 years and rose a total of 417%. So this bull market appears to be getting a little long in the tooth compared to previous cycles, although it should be noted that the sample size of 12 is too small to draw hard and fast conclusions. But there is a better, more empirically valid reason to believe that this bull market is reaching its end, and that is valuation. Now, in the financial media, there is a constant debate over whether the stock market is overvalued, undervalued, or fairly valued, and there are all kinds of methods thrown out to prove each particular point of view. But as John Hussman of Hussman Advisors notes, one of the most important questions to ask about any valuation method or indicator is, how strongly is this measure related to actual subsequent market returns? That is, how much of a good job does any particular measure do of predicting stock market outcomes when applied to historical experience? If people ask that question first, they could save themselves a great deal of time and probably money, since the vast majority of valuation indicators used by so-called professionals and non-professionals alike don't stand up to that type of scrutiny. So who is this John Hussman character I speak of? John Hussman is the president of the Hussman Investment Trust and the author of the weekly market comment put out every Monday on the Hussman Funds website. Link is below. Now, is John Hussman some type of stock market guru that can tell you exactly when to buy and when to sell and make you $1 billion? No, he isn't, and he doesn't pretend to be. He's been wrong in the past, but unlike most, he willingly admits his mistakes and tries to learn from them. But the reason I read his weekly market comments, and have been for over a decade, is because he is completely data-driven. He's committed to objectively evaluating the evidence. And so when John Hussman claims that the stock market is overvalued, you can be assured that he has the empirical evidence to back up his claims. So I'm going to borrow heavily from Hussman's weekly market comment of September 12th this year, entitled Party Like It's 1999 and 1929. This chart shows the ratio of non-financial market capitalization to nominal GDP, an indicator that Warren Buffett was once quoted as saying is probably the best single measure of where valuations stand at any given moment. As you can see, the only time in the past century when the stock market has been more overvalued was the 1929 and 2000 market peaks. Now, taking that same chart and inverting it, and then mapping onto it actual S&P 500 total returns over the subsequent 12-year period shows a very tight correlation. In fact, the correlation is around 91%. So this valuation method is highly predictive when it comes to subsequent stock market returns. And as denoted by the green arrow in the bottom right corner, given the stock market levels of today, this measure predicts investors are looking at a dismal annualized return of about 1.5% over the next 12 years. If you go back to the 2000 peak, this same valuation metric predicted slightly negative annualized returns over the subsequent 12-year period, which was very close to the actual less than 1% annualized returns experienced by investors. Understand that valuation levels similar to the present have never been observed without the stock market losing half its value or more over the completion of the market cycle. Now, of course, that doesn't mean the stock market definitely has to lose 50% or more over the completion of this cycle, but that such a loss should be a run-of-the-mill expectation for any investor. Now, in my video about economic cycles, I mentioned the "this time is different" fallacy that always seems to crop up at the end of every speculative episode. Listen carefully to what Hussman has to say on this. Quote, "The danger of the current iteration of 'this time is different,' I think, is in how elaborate and far-reaching the underlying fallacies have become. By equating the delay of consequences with the absence of consequences, investors have now set up the most extreme episode of equity market speculation in US history next to the 1929 and 2000 market peaks. It's not just that investors have oversimplified a complex interaction, which they are certainly doing here in assuming that easy money makes risky assets go up. This simplification fails to explain, for example, how the US stock market could lose more than half of its value on two separate occasions since 2000 during periods when the Federal Reserve was persistently and aggressively easing. It also overlooks that the Japanese stock market shed more than 60% of its value on two separate occasions since 2000, despite short-term interest rates that were regularly pegged at zero and never breached even 1%. The historically supported but more complex statement recognizes that the relationship between monetary policy and the financial markets is not reliably mechanical, but wholly psychological. Easy money operates by creating safe but low-interest liquidity that someone in the economy must hold at every moment in time until it's retired. Investors often treat that liquidity as an inferior and uncomfortable hot potato, but only if they don't see safety as desirable. So the accurate statement is that easy money can encourage speculation, but only does so reliably when investors are already inclined to speculate. The fallacies underlying today's "this time is different" mantra go even further, assuming not only that central bank behavior has permanently changed, but that we can also abandon everything we've learned from centuries of economic dynamics, human behavior, and even basic arithmetic. Having repeatedly borrowed enough short-lived bursts of consumption from the future to keep US real GDP growth barely above 1% over the past year, and indeed over the past decade, monetary authorities have convinced investors of a cause-effect relationship between activist monetary policy and economic outcomes that is entirely absent in actual data. Worse, central bankers have convinced investors that the progressive overpricing of financial securities can substitute for actual growth. Unfortunately, with every increase in price, what was prospective future return a moment earlier is suddenly converted into realized past return, leaving nothing but lower expected returns and greater risk on the table for investors who continue to hold those securities. The essence of a Ponzi scheme is to reward investors who leave early out of the capital of investors who arrive later, thereby ensuring losses for anyone who stays. What else is the current central bank policy but a massive greater fool Ponzi scheme? What else indeed? Now, if you're not familiar with financial markets and may be confused by some of the concepts and terminology used in this video, don't fret it. Just know this. Central bank intervention in the economy may have extended the current stock market cycle by encouraging speculation, but as history has shown, they do not have the power to repeal the completion of this cycle, and that given the strenuous overvaluation of the stock market today, there will be an ugly reckoning that no central bank will be able to stop. So what do? Well, I'm not a financial advisor, so I'm not going to give advice, nor should what I say be taken as such. And of course, you need to take into account your own personal circumstances. All I can tell you is what I've done recently and what I will continue to do, and that is buy long-dated, out-of-the-money put options on the S&P 500 and the Russell 2000. And just to be clear, none of what has been stated in this video is a prediction of an imminent market collapse. Rather, this is simply a historically informed recognition that we are in a dangerously overvalued market with significant downside risks. Whether that downside begins to be realised in a week, a month, or a year from now is anyone's guess. But stay informed and be prepared.